Today's going to just have to be a short one, guys. I've got a couple headlines from CNBC that caught my eye, plus an email that I got from their mailing list I want to show you about. One's about the real estate market as well. You guys have restored my faith in humanity with your gold coin contest entries. We're going to show you a lot of those in this video. Plus, I'm going to give you an update about whatever happened to Tyson, my kitten that I got. I'll show you what he's like now. For many of you, this is your very first time here. My name is Peter Leeds, and I am the small stock specialist. You might ask yourself, why small stocks? Because they produce the biggest gains, if you know how to find them. And please understand that nothing in this video or anything we put out ever is intended as personalized trading advice for you. Now check out these emails I've gotten from CNBC. This is why I say I don't blame you if you fall for the conversation that the stock market is going to go so much higher, that it's going to hit a new high this year, or that there's opportunities in this chaos. And yeah, there's opportunities in everything. But right now is not the time necessarily to be looking for opportunities. You definitely want to wait for a bottom. And I don't think we're at a bottom yet. I think we're far from it. Is this historic tech sell-off a generational buying opportunity? Dan Ives says yes. In case you missed it, check out this week's past top 10 stories on CNBC Pro. Here's what Arkashian is watching as a sign it's time to buy stocks. Goldman says the market is trapped here, so stick with these stable stocks. Searching for stocks which might pop in a rebound. Look at these high short interest candidates. Historic tech sell-off is a generational buying opportunity. This sector could be unduly punished and could be a good buy right now. These stocks should help you sleep at night. Let me translate that for you. What they're saying is, here's what to buy, here's what to buy, here's what to buy, here's what to buy. It's all about, there's a pot of gold on the next train. It's all about, here's what you do to make money in the future. What you do is be ahead of the game. Be upstream. Prepare for things before they happen. All CNBC is doing is they're trying to tell you what has happened, and now they're trying to get you back into the fold. Here, one more for you from the Pro Playbook. Is the market clear of a bear market? They're just trying to encourage you to get back into investing again and again. They've been driving everybody into cryptocurrencies for so long, and now they're just talking about, well, here's why it went down. That's what people do. They say, okay, cryptos are at 70,000. It's going to go much higher. And it comes down, they go, okay, well, here's why it came down. The point of being a good analyst and a good investor is to see and understand that things can happen that are going to bring down the price of the asset. Rather than just making mistakes and then explaining why the mistakes were made, why not do things properly in the first place? You don't buy stocks at the top, you buy them once they've come down and they're good value. And I'm biased. I'm a fundamentalist. I believe that stocks are a share of a company. And I believe that a company can operate efficiently and effectively, and therefore the price of the shares will actually increase as the operations of the company do better and better. Call me crazy. That's the way it used to be. Until, if you remember a while back, I was talking about the detachment between the stock market and the economy. Most people think that it's the same thing. If the stock market's roaring along, they think the economy is doing well, and that's why it takes your eye off the ball. No one's looking at the economy. The economy is a train wreck. How are we going to get out of this? A lot of people are going to be facing a decline in their quality of life as this all plays out. Are we out of the woods yet? I think that the darkest part of the woods is still ahead of us. Speaking of being upstream or ahead of the curve, I told you ages ago that the stock market was way over its skis, and now you're seeing the results of that. And I told you ages ago that the real estate market is going to come down, and now it's begun. And the thing that most people aren't realizing is that if interest rates did not increase, the real estate market was still coming down. This is just going to make it so much worse. To that end, here's an article from CNBC. Existing home sales fell in April to the lowest level since the start of the pandemic. And this is all playing out in Canada too. There's massive declines in the number of people shopping for homes. The prices are starting to come down. This market that's been whipped up into a froth is starting to turn the corner and slow down a little bit. And that's how it begins before it gets a lot worse. Sales of previously owned homes in April fell to the lowest pace since the COVID pandemic started, according to the National Association of Realtors. Tight supply kept home prices higher. Yes, that's exactly what's driving up the prices, besides all the monetary creation and the lack of options of where else to put your money. Tight supply kept home prices higher despite rising interest rates. The median price of an existing home sold in April was $391,200, the highest on record and an increase of 14.8% from a year ago. And I just want to say and show you one thing that I thought was pretty funny. I showed my son earlier when he stopped by. This is the picture from CNBC Pro with this article, and they always put a caption underneath the picture so you know what it's about. So here's a picture of a sold sign in front of a home, and underneath the caption says, "A sold sign sits outside of a home." If you couldn't figure that out for the picture, the write-up's not going to change your outlook. We are moving back to pre-pandemic sales activity, but I expect further declines, said Lawrence Yun, chief economist for NAR, citing that rates are now higher than they were when the contracts were signed. Not only were buyers contending with rising rates, but they saw very little relief in the shortage of homes for sale. Everybody's focusing on the inventory, and as long as the inventory is tight, that's going to be a wind in the sales of home prices. But my premise is that inventory tightness will naturally loosen a bit. As there's more obstacles to purchase a home, to be able to afford the home you've already bought, that makes a difference in how many homes go on the market, the types of prices that home sellers accept. This is all a bunch of different avalanches that are all going to steamroll together. Sales continue to be more robust on the higher end of the market, where the supply is stronger. Sales of homes priced between $100,000 and $250,000 fell 29% year over year. A third of the value in 1 year. Think about that. That's a free fall. And that's with only interest rates rising a little bit and the upcoming depression only gradually getting here. A home is the most expensive thing that people generally buy. First-time home buyers are already priced out of the market, and rent prices are going up a lot too, so it's making it harder to save up to buy a home. But imagine that. The most valuable thing that you purchase drops by a third in value in 1 year. You've just got 1/3 less worth. Just like with a lot of the inventory that a lot of businesses bought when there was supply constraint concerns, there's a lot of homes that will then join the market. It's going to be a glut of people trying to sell. It will be a buyer's market, not a seller's market. Right now it's a seller's market. That will shift. So what you're going to have is a glut of homes for sale, just like you're going to have a glut of products and inventory with a lot of companies. They've overloaded their inventories, and now they're sitting there with all this inventory, and they're going to have to either cut the prices down on a lot of it or liquidate it somehow, or deal with the fact that they've overextended in terms of collecting all this stuff, especially at a time when the entire economy is slowing down. I can tell you this from the perspective of my business and a lot of other businesses too. You can see it playing out. Further to that end, I want to get to this next article from CNBC. It's basically telling you what some of the major retailers are indicating based on their financial results. Here's what Walmart, Target, Home Depot, and Lowe's tell us about the state of the American consumer. I went into a Lowe's the other day and I bought a washing machine. And first of all, the washing machine was dramatically higher in price than they used to be, and I bought the least expensive one. And they've got all these washers for over $1,000 for a washing machine. And they justify the price because they say that you can connect your Bluetooth to your washing machine. You can connect your smartphone to your washing machine. I've got a washing machine here that can be connected to the Bluetooth through my phone. And I can tell it to do what? Press a button that says wash the clothes. I don't understand. I think we're getting way too crazy. Just because we can do things technologically doesn't mean that we need to. Home Depot and Lowe's have seen strength among shoppers in recent weeks. What is strength? Strength is how much money they spend. But they are forced to spend that. You buy a washing machine, it costs 50% more, and so you pay it. And they say, okay, well, we just made 50% more from the strength in the shoppers. It's not like we have a choice. We have to spend more. But then what happens is that people will start spending less, especially when all this inventory starts to get fed out to consumers when the businesses start to run into a little bit of trouble because nobody's buying anything anymore. While we're experiencing high levels of inflation in our international markets over the years, U.S. inflation being this high and moving so quickly, both in food and general merchandise, is unusual, Walmart's CEO said. It's not actually unusual at all for the setup that we're in. Based on the setup leading up to this, it's exactly what you should expect to see. Our customers are resilient. We're not seeing the sensitivity to that level of inflation that would have been initially expected, Home Depot CEO Todd Decker said on Tuesday on the company's earnings call. Maybe you haven't seen the sensitivity yet. When they report their financials, that's actually months after the fact. When they've got a 3-month period, which makes the quarter, then you've got a month and a half or more, depending on which quarter they're reporting. If they're reporting the annuals, they've got more time than that. But the point is, your customers are resilient. You're not being affected by inflation yet. Just wait till the next numbers come out. Are we in a recession right now? I don't think we are. But I do think we're going to have a recession likely this year. In terms of Tyson, my Russian blue kitten that my son Davis got and named Tyson, why it's so hard to call oil. Plus, there's a whole bunch of other headlines and things we got to touch on, a few administrative points, and we'll get to that in this very video. He lives with my kids now, and this is what he looks like. He's in great shape, great health, and he's leading the happiest life ever. And the reason I say that you guys have restored my faith in humanity is because I put out the gold coin contest and the gold coin contest video, which nobody cared about, nobody watched. Some of you did, and you guys matter. But I'm saying that I thought it would be a bigger thing, and everyone's talking about how the economy is so hard and they can't get a leg up. And I'm like, here is a $2,000 thing I'm going to give to you at my cost. And nobody really seemed to care, but some of you really cared. And I got your photos for the photo contest, and we're getting a lot more now. I'm going to have to show you more of them in each of these videos like I'll do right now. These are some of the entries into the gold coin contest. And if you want to get involved with this, we've got a lot of prizes that we're giving out. The Peter Leeds Academy, worth $369. It's worth a lot more than that, but that's the price of it. The Peter Leeds 33 Profit Patterns Trading Chart Course. It goes for $269 or $249 or something like that. It's worth tremendously more than that. And a copy of my digital book, Up Thinking, not to mention the gold coin, and anything else we think about between now and when we start giving out prizes. You guys have restored my faith in humanity that there are a very small slice of people that really care, and you really understand what I'm doing here, and you get what the whole Peter Leeds brand is about. And so if you guys want to get in on the gold coin contest, if you're not yet, just go to peterleeds.com/coin, and you can learn how to submit your photo to be in the running for everybody to vote on. I don't vote. Nobody that works for me votes. No one I know votes. You guys all vote on it. You choose who is deserving of the coin based on the photo they sent in. Till the end of the month, we're accepting entries that you can send to tammy@peterleeds.com, and then we'll curate them into one place, and you guys can go there and vote on which one you like best. So like I said, a short one today, but make sure to subscribe to the channel and get involved with the gold coin contest, peterleeds.com/coin. You guys will love it. And as always, we love you being here. We hope we're helping you out.